Kalady welcome Dr. Vijayakumar sir to this auspicious session. And I also welcome all the faculties and participants to this session.
Sir, shall we present the...
Nothing else? Shall we straight away go to the presentation?
Yes, sir. Yes.
Oh, okay. You can put on the slide, Gopika. You can put on the slides.
Okay, sir.
Good morning to all the participants. A warm welcome to this presentation on wealth creation through the stock market. Since all of you are members of the faculty, I believe I can handle the topic at a higher level. But then I will start from the basics. Normally, these topics are presented for students of economics and commerce, and also to the MBA students. Therefore, the initial part will be basic. I will very quickly go over that. And then we will go into the significant, more sophisticated, advanced segments of the presentation. As you can very well see, the topic of the presentation is create wealth through smart investment. We hear about wealth creation a lot these days. We hear about billionaires being created in the market. Now, it is very important for you to understand what is wealth creation and how even ordinary people like you and me can participate in the wealth creation that is happening through the stock market. Therefore, I will start with the basics. We'll go to the next slide, Gopika. We'll go to the next slide on the structure of the presentation. So let me explain to you, this is the structure of the presentation. We start by looking at the importance of savings, investment, and wealth management. You are familiar with this, therefore I will not explain this in detail, but I will be emphasizing the wealth management part and the wealth creation part, because the significance of wealth creation is even now not yet fully appreciated by even finance professionals. I've been surprised. Even 4 months back, I addressed the Southern Regional Conference of Cost Accountants of India, and I was surprised by their ignorance regarding the market. Many of them, including senior people. So even finance professionals have a deficient understanding of how the market functions and how wealth is created. So that is why it is important for all of you to understand what is wealth creation, how wealth creation happens to the stock market, and how ordinary people can participate in this wealth creation and become rich through systematic investment. So we'll discuss the savings, investment, and wealth management very briefly. Then we will move on to the investors' expectation. What investors expect when they invest money in various asset classes. Then we move on to the various asset classes available. Normally, ordinary people invest their money either in bank deposits or small savings like national savings certificates or a public provident fund, or they invest in gold. And when they choose gold, they can either buy the gold ornaments or the gold exchange traded fund or sovereign gold bonds. There are different options. Then some people invest in the stock market. Some invest in the stock market through the mutual fund route. And today you have new instruments available called infrastructure investment trust, InvITs, and real estate investment trust called REITs. Large number of new financial assets are available. So we'll very quickly look at the various asset classes like the ones that I mentioned just now, and we will examine the risk return profile of these various asset classes. Then we will go into the tax implications of investment, because it is very important to pay tax, and from a personal investor's perspective, it is important to minimize the tax burden. So it is very important for us to understand how we can pay as citizens, how we can pay a tax to the government and be a responsible citizen, while at the same time minimizing the tax burden through tax saving instruments. So we'll look at the tax implications of various asset classes. Then I will invite your attention to the changing investment landscape in India. The investment landscape is changing very fast. Globally, it is changing. In India, also, it is changing. The Indian investment landscape today is very, very different from what it was some 20 years ago or 30 years ago. I started investing in the market in 1984, and the stock market at that time was very different from what it is now. The returns have changed dramatically. The investment options are available. Different kinds of investment options are available. Now, sitting in my home in Thrissur, I can invest in the shares of Apple, Google, Netflix, Microsoft, Amazon, the companies that are changing the world or that have already changed the world and has rewarded investors handsomely. So globalization is not just in investment and trade, but in personal investment also. There are global opportunities that allow you to diversify your investment across geographies. Sitting in your home in Kalady, if you are staying in Kalady, for instance, you can invest in asset classes all over the world. You can invest in the top companies of United States of America, in Europe, in Japan, emerging markets like Brazil, Mexico, wherever you want. But very few people are aware of these opportunities, and therefore many are missing on these opportunities. I told you some time back when I started this program that even finance professionals, I told you about the lecture that I gave to cost accountants a few months back. 95% of the participants were not aware of the fact that you can invest in foreign stocks, in US stocks, in European stocks, through the mutual fund route, through the fund of funds route, etc. The point that I am trying to say is that even if even financial professionals do not know this, well, you cannot expect the ordinary people, even the educated ordinary people, to know. So, as members of the finance, commerce, management faculty, you have a responsibility to know about these developments that is happening in the investment landscape, and also impart this knowledge to the students. And surprisingly, let me tell you this, sometimes new students are more knowledgeable than teachers, because the new generation are tech savvy, and because they are tech savvy, they are visiting large number of sites and gaining information, right? Recently, we had this incident in Kerala where a plus 2 student exposed a big blunder committed by Jacob Alexander regarding the Harvard University thing. I think you would have heard about that. So youngsters are very, very, very tech savvy these days. So students also can be expected to know a lot. So you can become a good teacher only if you are a good student. And a good student should be a perpetual student, learning every day about the latest developments in your chosen area of specialization. So I'll explain this changing investment landscape, and then we will go to the emerging opportunity and conclude my presentation. Shall we go to the next one, please? So let us go into the basics of savings, investments, and wealth. Next one, please. Next slide. Savings, investment, and wealth. Saving, we know, is the balance in income after meeting your expenses. Your income is 45,000 rupees a month. Your expenses 30,000 rupees a month. So 45,000 minus 30 equals 15,000 rupees. That is your saving. But in financial management, we tweak this definition a little bit. This income minus expenditure equals saving is the economic definition. In modern financial management, we tweak this definition a bit and say that income minus saving equals expenditure. This is to highlight the importance of savings. It is very important that you start saving very early in your life, very early in your career. All of you are very young. I presume that you are in your, many of you I am sure are in your 30s. Some of you may be in your early 40s. Whatever might be your age, you are in the early phase of your career. And it is very important that in this early phase of your career, you start saving and invest this money systematically. If you start early and invest systematically in the long run, that will create phenomenal wealth for you. I'll give you examples later on. So first you have to understand this distinction between economic savings and financial savings. In economics, income minus expenditure equals savings. In modern financial management, income minus saving equals expenditure. That means you should spend only after saving a part. And investment, we know, is deploying money for a return or profit. You are deploying the savings for a return or a profit, that is called investment. Now, what is wealth? Wealth is very frequently used. What is wealth? The concept wealth, which is very frequently these days. We have wealth management also. While I was a student, I had not heard about wealth management. Even financial planning is a concept which is of a recent origin now. Wealth management also, even when I was teaching in the college, I have not used the financial planning and wealth management because it was not a very popular concept 10 years ago. But that is not the case now. Wealth management is given a lot of significance. The reason is appropriate wealth management. Smart financial planning and wealth management can create incredible wealth. So what is wealth? There is no accurate definition for wealth, like for example, the definition of savings, investment, income, etc. But we can say wealth is, broadly, abundant valuable possession. If you have a valuable possession and if it is abundant, we call it wealth. If you have, let us say, 50,000 rupees in bank deposit, that is not wealth. If you have gold worth, let us say, 15 sovereigns, that is not wealth. If you have 5 cents of land in a rural area, that is not wealth. Wealth is abundant valuable possession. Valuable possession in abundance. That is why we say a rich person is a person with such and such amount of money. High net worth individuals with more than, in India, for example, a person with more than 3 crores is regarded as generally belonging to the high net worth category. And also it is very important for you to understand that wealth today is very different from what it was in the olden days. As students of finance, you must be knowing this. There was a time when wealth was cattle. Cattle represented wealth. There's a word called pecuniary in English. Pecuniary comes from the Latin word pecus, and the pecus in Latin means cattle. Pecus means cattle. So pecuniary means cattle related. But now in modern English, pecuniary means financial. I have some pecuniary problems, I have some financial problems. So there was a time when cattle was wealth because the land had no value. Land was available in abundance. Even in my childhood, I remember land had no value at all. Land was available in plenty. You could buy 1 acre, 2 acre of land in rural areas with 500 rupees, 300 rupees. But then what happened was later on with the urbanization, when cities and towns started coming up and cities and towns started growing, land became a valuable possession, a valuable symbol of wealth because the price of land started shooting up. Then after the formation of the International Monetary Fund, and when dollar was linked to gold, and dollar came to be accepted as the international currency for international settlements, gold started gaining in value. And after President Nixon withdrew from the commitment to convert dollars into gold, there was a sudden flare-up from 1973 to 1980. There was an explosion in the price of gold, and gold became an important symbol of wealth. It must be interesting for you to know that if you look at the returns from gold during the last 100 years, 150 years, that is very, very poor. Gold has been a poorly performing asset class. Even now, not a great performing asset class. In India, the situation is different because rupee depreciation has increased the price of gold. In 1980, $1 was 8 rupees. Now $1 is 75 rupee 40 paise as I speak now. So that means dollar has appreciated by 9 times, 900%. And much of the increase, 900% increase in the price of gold after 1980 in India is because of the depreciation in rupee and the appreciation in dollar, because the price of gold is always linked to the international price. But then that also became an important symbol of wealth. But you must understand that in modern days, the most important symbol of wealth is stocks. We say Jeff Bezos is the richest man in the world for Amazon, or Tesla's Elon Musk. These guys are changing positions because when the share price of Tesla increases, Elon Musk becomes the richest person in the world. When Amazon declines, that is favorable to Elon Musk. When Amazon goes up and Tesla declines, again Jeff Bezos becomes the richest person in the world. So whether it is Jeff Bezos or Elon Musk or Bill Gates or Mukesh Ambani in India or whoever, the rich persons are rich by the value of the stocks which they own. These guys don't own a lot of other property. For example, take the rich people in Kerala. I am fond of one person, Chris Gopalakrishnan. To give you an example, a very good example, the richest Malayali, as we all know, is Yusuf Ali. But Chris Gopalakrishnan, one of the founders of Infosys, is one of the richest Malayalis. He now, his wealth is around 13,000, 14,000 crores. And what is this 14,000 crores? Chris Gopalakrishnan is a very simple guy, born of middle class parents. And even now, he leads a very simple lifestyle. The 14,000 crores of wealth that Chris Gopalakrishnan has is the value of the Infosys shares that he holds. He does not own hundreds of acres of land, and I don't think his wife has even 50 or 100 sovereigns of gold. These are very simple people who lead a simple lifestyle. So this 14,000 crores is the value of the Infosys shares that he holds. So stocks is a symbol of wealth now, is the most important indicator of wealth, right? And any person who invests in the stocks, and if the stock market does well, if the company in which you invest money does well, ordinary people can participate in this wealth creation. That's why I have written these last two sentences in this slide in green. Please read that. Income is earned, wealth is not earned, it is created. It is very, very important. This is very simple truism, but I believe it is a big secret which even now most people do not know. It is sublime wisdom. Income is earned. That you know. Whatever you are, whatever a person is, you may be an agricultural laborer working in the paddy field in Kalady, or you may be a school teacher or a college professor or a banker or a cardiac thoracic surgeon or a lawyer. So whatever you are working and earning money. Agricultural laborers, school teachers, college professors, surgeons, all these people are working and earning money. So income is earned. Wealth is not earned. That's a key to wealth creation. Wealth is not earned, wealth is created. And how is wealth created? Read the last line in blue. Wealth is created through systematic, intelligent, long-term investment. This is the lesson of last 150 years of financial history. If you read the last 150 years of financial history in the developed world and now in the emerging markets like India, you will easily understand that wealth is created through systematic, intelligent, long-term investment. Huge wealth creation is possible. Before we started this presentation, I was having a very informal chat with Gobika and Shalini, and I told them about 4 books written by Saurabh Mukherjee, one market guru whom I respect a lot. And in one of the books that he wrote, Coffee Can Investing, he gives a large number of examples. I would request all the commerce professors who are attending this class, if possible, to read all the 4 books. Gurus of Chaos, Coffee Can Investing, Victory Project, and the last one, Diamonds in the Dust. All are books which are intellectually spellbinding. I read each book within a few days because it was a lot of information, information which you will not get from library books. These are all latest information from financial markets, from companies. At least if you don't have time, at least read Coffee Can Investing, in which a large number of examples are given of wealth creation. So one point, let me finish this slide just by emphasizing this point. Income is earned. There's a limit beyond which you can make money by working during your lifetime, even if you work 35 years, 40 years. There's a limit beyond which you cannot create wealth. But if you invest money very smartly for the long period, and if you have patience, then phenomenal wealth creation is possible. I'll give you an example. Some of you would have heard about this. Those who have not heard about this will find this very difficult to believe, but it is fact which you can check. One of India's great companies, Infosys, company which is well known for not only its competence, global competitiveness, the wealth creation, corporate governance standards. This company came out with this IPO, initial public offering, in 1993, and one share was offered at a price of 95 rupees, 85 rupee premium to the 10 rupee face value. So 95 rupees was the issue price. Anyone who applied for the shares got allotment because the issue was not fully priced, or fully subscribed, because nobody knew that this is going to be a great company, even such a phenomenally successful company, perhaps India's most successful company. Even the promoters did not have even a vague idea of what the company is going to be, because this is explained in detail by all the promoters in their writings. Even the promoters did not have any vague idea of how this company is going to grow. It was the digitization, the Y2K, and the IT revolution that happened in India, plus the 1991 reforms, which transformed the IT industry from a 100 million industry to 165 billion in exports this year. So suppose you had applied for 100 shares of Infosys in 1993, you would have been allotted 100 shares. And what is your investment? 9,500 rupees. Suppose instead of investing in 100 shares of Infosys, you deposited that 9,500 rupees in State Bank of India, Kalady. I'm giving Kalady example because the Sree Sankara College is in Kalady. You deposited 9,500 rupees in Kalady, State Bank of India. This morning, today morning, at 10 o'clock, you go to the Kalady State Bank of India and withdraw your fixed deposit. It was an open-ended fixed deposit. You had given instruction to the branch manager to renew the deposit every year. So this morning you are withdrawing the deposit. After how many years? 28 years. How much you will be getting? Your 9,500 rupees of investment would have grown to around 1.95, let us say 2 lakhs of rupees. this 28 years, it has grown to 2 lakhs. I am not taking into the taxation part. It would make the amount much lower. So your investment of 9,000 rupees has become 2 lakhs. Suppose at the same time, the person who invested 100 Infosys shares in 1993 and who had been keeping his shares intact, this 10 o'clock this morning, at the same time, the other guy went to the branch of State Bank of India and withdrew his deposit and got 2 lakhs. At 10 o'clock, you sell all the shares of Infosys that you have. How much you will be getting? Some of you may be knowing this. You would have read about that. And if you don't know, you will be shocked to hear this. You will be getting more than 18 crores of rupees. Not 18 lakhs, 18 crores. This is an example of phenomenal wealth creation. Because the original 100 shares have now multiplied to more than 1 lakh shares through bonus issue of shares. You know bonus issue of shares by capitalization of reserves. 1:1 bonus in 1994 itself. 100 became 200. 1:2 bonus. 1 bonus again 2 years. 200 became 400. 400 became 800. Then the company gave a 3:1 bonus. So 800 became 3,200. Like that, now it is more than 1 lakh. And if you sell now, you get around 18 crores. I have not included the millions of rupees that you got as dividend during the last 28 years. This is wealth creation. And that's why we say wealth is not earned, wealth is created through systematic investment. Income is earned, and there are limits to earning income. I hope this wealth creation part is understood now. I would have given you large number. There are not this example. There are plenty of other examples also, but this is a classic example of wealth creation. Globally, Microsoft, Amazon, Netflix, Google, Facebook have created this kind of phenomenal wealth creation. In India also, Asian Paints came out with their IPO in 1983. After that, the stock price has multiplied 2,500 times. 2,500 times. Similarly, HDFC Bank, large number of stocks are there. At the same time, suppose I gave you this example of Infosys, 9,500 rupees becoming 18 crores of rupees. Suppose instead of investing in the 100 shares of Infosys, you invested in 100 shares of a finance company called Ross Murarka Finance. Ross Murarka Finance, a leasing company, also was quoting around 95 rupees at that point of time. Suppose you invest in 100 shares of Ross Murarka Finance in 1993. How much you will get if you sell the shares now? You will not get even 1 rupee because the company has gone bankrupt. So a lot depends on where you invest, on your ability to invest, on your ability to choose the right kind of asset class. And if you are investing in stocks, your ability to identify right stocks of investment, your ability to analyze balance sheets and profit and loss accounts, read balance sheets, financial statements, and things like that, right? So let me go to the next one, please. I spent a lot of time on this because wealth creation is hugely important. Shall we go to the next one, please? Why do we say that invest? I'm not explaining this slide because it is self-explanatory. Now, to beat inflation, suppose you are depositing money in bank. The bank gives you 5% now. After tax, it will be 4%. Let us say 5%. The current inflation in India is more than 5%. If we assume it to be 5%, your real return is 0 because we know real return is nominal return minus inflation. So unless you invest in an asset class that beats inflation, you are not investing prudently. So it is very important to beat inflation, to make your money grow, to acquire a house of your own, a vehicle of your own, an electronic gadget of your own. We have aspirations like that. For travel, vacation, the youngsters these days have a lot of aspirations like traveling abroad, vacation. Then children's education is very expensive. My mother told me when I got my job in the college in 1978 as lecturer, and when I gave my first month's salary to her because I was very attached to her, because she had suffered a lot in giving me the education that I got. So she asked me a question, do you know how much money I spent on your education? I said no. She said 2,000 rupees. She was very good in accounting. 2,000 rupees for 17 years of my education. From first standard, we did not have kindergarten at that point of time. So first standard to final ME, 2,000 rupees was the total amount spent on my education. Now for my granddaughter is in the 6th standard. Her monthly fees is 10,000 rupees. 1.4, close to 1.3 lakhs of rupees is her annual fee, which I'm financing her education, because I feel very proud to finance the education of my granddaughter. So it is, what I'm trying to say is it's very expensive now. And also marriage in India, marriage should be simple, but then unfortunately marriage is an expensive proposition, particularly marriages of girls. Then planning for retirement, I tell you, it is very important. Planning for retirement has not been a priority at all. One of my classmates, schoolmates, when he sought my advice for some investments in mutual funds for his children also, he told me, Vijayakumar, I did not plan for retirement at all. Now I realize it was a foolish decision. He's a chartered accountant, a very smart guy actually, but then he did not plan for retirement. It's very important to plan for retirement. And also finally, when we go away from this world after death, then it gives a lot of satisfaction if we pass on the wealth that we have created to the next generation, our children. Next one, please. This is the reason why we save and invest. Now, what do we expect from investment? When we invest in various asset classes like bank deposits, gold, real estate, small savings, stocks, bonds, real estate investment trust, what do we expect? Very quickly, one is returns, regular returns from investment. Bank deposits give you, if you are withdrawing interest every month, it gives you regular returns, but no capital appreciation. Capital appreciation means the value of the asset class in which you have invested money should go up. Gold gives you capital appreciation of the long run, but there is no regular return unless you have invested the money in sovereign gold bonds, which gives you 2.5% return. Third is liquidity. Liquidity, as we know, is the ability of an asset class to be converted into cash at short notice. Bank deposits are liquid. High quality blue chips are liquid. Gold has liquidity. Real estate don't have liquidity. Public Provident Fund does not have liquidity. Safety. Safety is very important, particularly for investors in Kerala. In Kerala, we have a remarkable ability to chase unsafe asset classes and lose our money. Not a new phenomenon. Even in the 1980s, we had a Theke Manjiyam scandal in which a lot of people, including IAS officers, lost money. And now we had recently a large number of Ponzi schemes like LIS, large number of schemes in which people lost money because people invest in asset classes which are not safe. Then fifthly, if an investment gives you tax benefits, it is ideal. So these are the 5 things that we expect from investment. There is no asset class which will give you all the 5: returns, capital appreciation, liquidity, safety, and tax benefits. But blue chip stocks and mutual funds can give you all the 5, not all the stocks. I'm not saying that stocks give you all the 5. There are many stocks in India. I would say some around 50% of stocks are not liquid. You cannot sell because there is no demand. Sometimes if you go to the market to sell illiquid stocks, there are no buyers. But high quality stocks like Infosys, HCL Tech, Larsen and Toubro, HDFC Bank, ICICI Bank, Reliance Industries, Hindustan Unilever, you can sell any second. Any second, there will be thousands of buyers, thousands of sellers. So blue chip stocks can give you returns, capital appreciation, liquidity, safety, and tax benefits. But in the short run, there will be risk associated with that. We go to the next slide, please. And this is a bird's eye view of the various asset classes available for investment: bank deposits, equities, bonds and debentures, mutual funds, gold, insurance products, real estate, then real estate investment trusts, REITs, and infrastructure investment trust, InvITs. Let's go to the next slide, please. Here you have a broad, this slide will give you a broad idea of the various asset classes and the risk return profile of these various asset classes. Today, bank deposits give you only 5% return. 5% is the 1-year return from State Bank of India, 1-year fixed deposit. Very low. It's not sufficient to give you an inflation beating return. But then bank deposits are safe. The first part of the investment should be in bank deposits. The risk is very low. There is no diversification when you put money in bank deposits. What do I mean by that? Now, if you invest in, for example, if you are investing money in a mutual fund, an equity mutual fund like, let's say, ICICI Pru Blue Chip Fund or Axis Blue Chip Fund or Invesco Top 25 Fund or Motilal Oswal Top 100 Fund. These are all equity funds. And where do they invest money? They invest money in high quality blue chips. High quality blue chips from across sectors. For example, if you take any of these mutual funds which I have just mentioned now, you will find Infosys from IT industry. You'll find HDFC Bank or ICICI Bank or Axis Bank from the banking sector. You'll find Hindustan Unilever, Godrej Consumer, ITC from fast moving consumer good, FMCG. You'll find Ultratech Cement, ACC from the cement space. You'll find Asian Paints or Berger Paints from the home decorative segment. You will find PD Light from the adhesive segment. You will find Larsen and Toubro from the engineering segment. So what I'm trying to say, investment is spread across industries so that there is appropriate diversification. And it is our experience that whether you have recession or boom or whatever might be the economic scenario, some industries will do exceedingly well and some industries will be doing average and some industries' performance will be impacted. During COVID, one industry did exceedingly well, that was pharmaceuticals. What we say, when there is sickness all over the world, demand for pharmaceutical products increased, and the pharmaceutical industry did exceedingly well in 2020 because of COVID. So if you diversify your investment across various industries, well, the benefit of diversification will be there. So if you are investing only in one asset class like bank deposits, or in one asset class like gold, there is no diversification. Whereas if you invest in stocks or in mutual funds, there is diversification available. So if you take this direct equity, there is diversification, and there is very high probability of capital appreciation, whereas there is no capital appreciation in bank deposits or post office savings bank deposits or public provident fund, etc. The very important takeaway from this is the risk in investment in direct equity. I'm not explaining this in detail because the table is self-explanatory. If you're investing in direct equity directly or through mutual funds, it is possible to get 15% return a year, CAGR. Not every year. In some years you will get 15%, some years 20%, some years 10%, some year it may be 6 or 7, some year it can be 1 or 2, and once in 4 years or once in 5 years it can be even negative. It will be. Markets are very, very volatile. So that is the risk of investing in the market. But experience tells us that in the long run, stocks outperform all other asset classes. So you can, at leisure, you can use this slide. Normally, I don't use this slide. I mean, give the slide away because it is the intellectual property of Geojit, which I have created. But then Gobiga is a good friend, and therefore I have taken the risk of giving it to her, assuming that you will use it as responsible academics without giving away that to anyone. And there is no intellectual property right trips. I will not be charging you anything for this. It is free. You can use it, but use it responsibility. Don't give it away to anyone. So you can at leisure you can look at this. So the risk of investment in stocks is very high in the short run. In the long run, there is no risk at all, but the returns can be very huge, and therefore it will compensate for the risk, right? The tax part I will come to later on because there are a couple of slides on taxation. The next one, please. We'll go to the next slide. So the fundamental principle of investment, a cardinal principle of investment, as you all know, is don't put all your eggs in one basket, because if you put all your eggs in one basket and if you drop the basket, all the eggs will become omelette. You lose everything, right? But this is the fundamental principle of investment for ordinary people. I repeat, for ordinary people, not for extraordinarily talented investment gurus. If you ask Warren Buffett, or India's Warren Buffett, the Rakesh Jhunjhunwala, they will say, put all your eggs in one basket and take care of that. That is their principle. Warren Buffett or Rakesh Jhunjhunwala will not invest in gold. They don't invest in gold at all. They don't believe in diversification. Their investments in stocks, because they have that kind of faith and they have created phenomenal wealth. And if the market crashes by 20%, they will not be impacted at all. But for ordinary mortals, don't put all your eggs in one basket. Diversify your investments among various asset classes like bank deposits, equity, debt, gold, real estate, provident fund, etc. And invest in various asset classes based on your goals and risk appetite. That is very important. How much you should invest, where you should invest will depend on your goals. What is your financial goal? Different people will be having different financial goals. Suppose you are in your early 30s. Both of you are working. Husband and wife, both are working. So you have double income. This is a time when you can take a little bit of risk because you don't have, your children are not yet born, or they are not yet in school. Therefore, that the expenditure on education is not there. Since you are young, there is no medical expenditure. So you have double income. Therefore, this is the time for you to take some risk and invest more money in risky assets like stocks. If you have a, let us say, suppose your goal is to construct a house of your own, your dream home, by, let us say, 2026, 27. So you are planning to buy a house by 2027, or you're planning to buy a car if you don't have a car, or if you have a car, you want to upgrade your car to a luxury segment car by 2024, 25. You want to buy an electric car which will be available in plenty in India at a cost of, let us say, 7 lakhs. So you are planning to buy a car in 2026. So depending on what your goal is, or your daughter is, suppose some of you are in your 40s, late 40s, I don't know. Some of you may be in your 40s and your children are growing up. They are in school and soon they will be going for professional education, and professional education is very expensive now. So you have to plan accordingly. Therefore, depending on your financial goals, you have to make investment. So invest more in the high risk return assets like stocks and mutual funds early in your career. Invest more in fixed income around retirement. By the time you reach retirement, let us say 54, 55, it is advisable to move into less risky. This is again not a general principle for everyone. If you ask me, I am now 66. By April, I'll be 67. Much older than all of you, by decades. But then for me, 90% of my wealth is in stocks, right? I don't intend to diversify that into fixed income, because I started investing when the BSE Sensex was 420, right? BSE Sensex was 420. Now it is 59,000. And the blue chip stocks were available at very attractive rates. Therefore, since I have invested somewhat smartly, I don't have to diversify even at this old age. I don't believe in fixed deposit investment or gold investment, even though there is some money there. So this is not a general principle, but then for the ordinary investors, diversifying your investment across various asset classes is very important. So what is the takeaway? The takeaway is invest in stocks and mutual funds for long-term wealth creation. I told you about the phenomenal wealth created by Infosys or HCL Tech or TCS recently, or Larsen & Toubro or Reliance Industries, Asian Paints, Pidilite, ICICI Bank. Ordinary investors can invest in these stocks and create wealth. And for that, you have to start investment at the right time, if possible, very early, right? So in the early part of your investment, your career, early part of your career, major part of your investment should be. Now, last year, one girl from Calicut, she came to me because she was doing PhD, almost on the verge of finishing her PhD, and she came for some inputs because her guide instructed her to go and meet me. She came here and I gave her some inputs, and then I told her, a very smart girl, I told her to start investment. She's already an officer in GST in Kerala. So I told her, you start the investment, and she started investments in systematic investment plans in mutual fund, and she is thrilled because her returns had increased. She said, "Thank you, sir. My investments are doing well." I asked her, "How much did you invest in this SIP?" She said, "I am investing 1,000 rupees every month." I told her, it is very absurd. Her salary is around more than, she's an officer, more than 62,000 rupees is the monthly salary, and she is investing 1,000 rupees. Her husband also is employed now. I told her you should be investing minimum 15,000 rupees or 10,000 rupees at least. So it is not sufficient that you invest. You should invest adequate amount of money. Then only you will experience phenomenal wealth creation. Let's go to the next slide, please. Next one. So why equity? This is very important. Why investment in equity leads to wealth creation? That logic is very important. Let me explain this with very simple, commonsensical explanation. When you are depositing money in a bank, you are lending money to the bank. And the bank uses this money to lend money to the borrowers. The bank gives you 5%. The bank gives a loan at, let us say, 9%. The 4% is what we call NIM, net interest margin of the banks. Right? The bank makes profit, you will not get a part of the profit. That you will get only if you are a shareholder of the bank. Right? So lending money to the bank is what you do when you deposit money in the bank. When you are depositing money in small savings like Public Provident Fund, National Savings Certificate, etc., we know that this money is used by the government mainly to finance the deficit in the government's budget. A part of the government's deficit is financed by these small savings. And government is not a very productive user of money. Government's expenditure is very unproductive. When all governments are running deficits, Kerala government is a very good example of unproductive use of money. So if you put money in, let us say, small savings, that money is not invested productively. If you are depositing, you are buying gold. Well, gold is scarce. It has got scarcity value. Because of the scarcity value, and because gold cannot be produced like steel or aluminum or zinc or copper, gold has scarcity value. And therefore, gold becomes a safe haven during times of uncertainty. Particularly during times of uncertainty, gold price goes up because gold is a safe haven asset class. But gold is not productive. It is not a productive asset. I can give you the example. When my niece got married in 1996, my sister's daughter. That was the first wedding in my immediate family. When she got married, my mother instructed me to give her gold. I don't like to give gold. I would prefer giving a portfolio. When my daughter got married in 2008, I gave her a portfolio of stocks like Infosys, HDFC Bank, HDFC, Larsen and Toubro, Bajaj Finance, Bajaj Finserv. Bajaj Finserv has multiplied 40 times. I wrote an article in Economic Times regarding that. If you are interested, I will send it. I will send it to Gobiga, and you can read it. Right? But in 1996, my mother is not very much impressed by stock market, particularly in 1996. So she told me, you give her one gold necklace and some 4 gold bangles. So as instructed, I gave her that. After her marriage, she is a scientist in the US. She flew to America in 1996. And my sister took all this gold and put it in the safe deposit locker of Federal Bank Thrissur. From 1996 till this date, this gold ornament is lying there in the safe deposit locker, totally unproductive. It is not used for any investment. It is not used for creation of assets. It is not used for starting a factory or business. It is not used for creating jobs. There is no economic activity. That's why we say bank deposits, small savings, gold, etc. have limitations in wealth creation. For instance, if you are investing in equity, for example, I'll give you an example. In 2008, Kerala's, I give you the Kerala company so that you can easily relate to that. Our own V-Guard. V-Guard came out with an IPO. Share price I believe was around 80 rupees. I remember after that I bought from the market also because the share price crashed. In 2008 we had that global financial crisis. So I applied for the IPO of V-Guard because I know that Kottayam Chitla is a smart entrepreneur and he will invest this money, the IPO money, in the expansion of his company. And the expansion of V-Guard, we know, is a good thing because they produce goods and services which are in demand. They create jobs for thousands and thousands of people. They give revenue to the government, tax revenue for the government. So this money which I as an investor who invested in the IPO of V-Guard has resulted in economic activity. This company has grown, company's profits have grown, and the share price has grown. Now the share price is around 240 rupees. This is the difference between investing money in the stock of a company and depositing money in bank or small savings. And if the company does exceedingly well, like Infosys or HCL Tech or Larsen & Toubro or Reliance or HDFC Bank or ICICI Bank or globally, like Apple or Amazon or Netflix or Google, the wealth creation is phenomenal because when profits explode, share price increases several fold. And that is the secret of wealth creation. But the risk is company's performance. If you choose the wrong stock in the wrong industry, perhaps your returns will be mediocre or very poor. And if you are very unlucky to choose a wrong kind of stocks, like for example, Anil Ambani's Reliance company, the company would have gone bankrupt and you would have lost money also. And that is the risk return profile of investment in equity. Shall we go to the next one, please? Very quickly. Equity beats other asset classes by a wide margin in the long run. This is not just Indian experience, the global experience of the last 150 years. You can read Jeremy Segal's book, Professor Jeremy Segal's book, The Future of Investing, in which he has a narrated financial history of last 150 years and explained beautifully that stocks outperform all other asset classes in the long run in all countries of the world. Sensex in 1979 was 100. Now it is, last month it touched the 60,000 in October. Now there has been a correction and now it is around 58,700. As I speak, it is around, let me look at the, it's around 59,000 now, just below 59,000. So that means 179 is now 59,000 means 60,000 means it has multiplied 600 times in 42 years, yielding a CAGR, compound annual growth rate, of 16%. But the important point is, even though the CAGR is 16%, much higher than the returns from a bank deposit or other asset class, the returns are highly volatile. That is what makes this asset class. Many people tell you, stocks, no, I'm not investing in stocks because it is highly volatile. Yes, it is volatile. There can be sharp ups and downs. In one day, the market can go up by 500 points. Sensex can go up by 1,000 points. It went up yesterday. Today, it is down by around more than 100 points. So in the short run, it can be highly volatile. But then you need not be bothering about, if you are a long-term investor, don't bother about the share price every day. Do you bother about the price of gold every day? You may be having a lot of gold ornaments, particularly ladies. Do you look at this gold price every day and become very concerned when the gold price goes down? No. Similarly, you need not be concerned, over concerned when the stock prices becomes highly volatile. That is the nature of the beast. It will give sleepless nights only to the traders and speculators in the market. You should not be a speculator and trader. Since 1991, when we started liberalization in India, our GDP grew 10 times, but sex multiplied 60 times. That is how the market behaves. Next one, please. Next slide. Now, it is very important to understand. I'm sure you must be knowing this, but again, I have learned from experience when I ask this question to my audience when I make a physical presentation. None of the participants have given me a correct answer so far. 100,000 rupees invested every month for 30 years. That means 360 months. Every month you are investing 1,000 rupees. If you get 6% return, it will 3.6 lakhs that you invest. 360 months, 1,000 rupees every month, it will become 10 lakhs at 6% return. But if you get 10% return, it will become 22 lakhs. But you know how much it will be at 15% return? Those of you who are not on mute, tell me how much it will be at 15% return. 10% it is 22 lakhs. At 15%, how much it will be roughly? Anyone? An answer? No idea. 15% is 50% more than 10%. But here the figure will be 70 lakhs, 70. 22 will become 70 lakh. The return is 15%. This is the power of compounding. And it is this power of compounding that generates wealth. If you are lucky to get 15% return, I told you during the last 42 years, Sensex has given 16% CAGR. So if you had remained invested for a long period of time, 15% returns or even 12% returns over the long run would have created huge wealth for you. I gave you the example of Infosys, Asian Paints, etc. But even mutual fund, for example, Nippon Mutual Fund, it is formerly known as Reliance Growth Fund. In 25 years, this mutual fund multiplied 125 times. 125 times. 1 lakh investment became 1.25 crores. I'm talking about a mutual fund, not a stock. This is what happens if you invest and wait with patience. Patience is the key here. If you are impatient, you leave the market. If the market crashes, you will not make money. Patience is the most important thing. Next one, please. Next slide. I introduced this slide because a faculty member in a college recently, I did this presentation for the MBA students and faculty during a national seminar 2 months back. So she told me that, sir, investment, even faculty members, commerce professors like me have not invested in the market, not even in the mutual funds, because we have many fears about the stock market. We have many concerns about the stock markets. Whereas our students are very much interested and they have already started investing. So will you emphasize this particular point about the fears? I told her your fears are unfounded, right? It is not the fear, actually it is a myth. The reality is different from the myth. So in response to her concern, I prepared this slide, fears, concerns or myths, and what is the reality? What is the myth and what is the reality? So let me take some 3 or 4 minutes to explain that. Stock market benefits only a minority. This is the myth, right? I have seen even economics professors. I had an argument with even the former finance minister of Kerala regarding this. Stock market going up, only a small minority benefits. Wrong. As students of commerce, you must have known this. 3 revolutions which completely transformed the world were financial revolutions. The economist J.R. Hicks, I would have explained this in detail, but Unfortunately, I don't have time for that. J.R. Hicks, the great economist, was doing research on industrial revolution, and he came out with this interesting information. He said, the industrial revolution happened in practice because of the financial revolution. Industrial revolution would not have happened in the absence of financial revolution. And he speaks about three financial revolutions. One is joy and stock companies. Two, the limited liability concept. And three, the stock market. J.R. Hicks found that many of the inventions of the industrial revolution, like flying shuttle, spinning jenny, steam engine, many of these inventions had happened many years ago, but these inventions were not put into practice because nobody was prepared to invest money. People had money, they were not prepared to invest. But when the joint stock company concept became popular and the limited liability concept was introduced in the law, people were adventurous, risky enough. I will invest my money because I will not lose my home. My liability will be confined to my investment. This limited liability concept was a great revolution. Many countries introduced it only in the 18th, 19th century. So this concept of limited liability, the joint stock company, and the stock markets, which gave liquidity for investors, that completely revolutionized finance. And that is why J.R. Hicks famously said, it was a financial revolution that made the industrial revolution possible. As finance professionals, you must be proud of that. And you should be teaching your students. I would be very delighted if you teach your students this famous saying of J.R. Hicks. Industrial revolution had to wait for the financial revolution. In the absence of financial revolution, industrial revolution would have to wait for several more decades. So the stock market had played a very important role in industrialization, economic growth, and development. Many people do not know this. And when I explained, I've seen many people telling me, oh, Vijayakumar, right, we have not known this particular thing, this financial revolution things. And that is why now every country of the world has a stock market. Why communist countries regard stock market as undesirable? There was a time, because the stock market is a symbol of capitalism, right? Now China, old Soviet Union, Vietnam. When I went to Vietnam in 2011, I spent some time before the Vietnamese stock exchange, looking at the Ho Chi Minh Towers, and I smiled to myself because Vietnam Communist Party had introduced Vietnam the stock exchange, right? So stock market plays a very important role in economic growth and development. And as professors of finance, you have a responsibility to explain that. Second is stock market is a myth. This is not a myth. This is a truth. Stock market is speculative. There is speculation. Speculation is allowed in the stock market because speculation provides liquidity. I told you, if you want to sell the shares of blue chip companies, any second you can sell. For example, if you look at the stock market quotations for let us say a share like L&T or HDFC Bank or ICICI Bank. You look at the quotation for ICICI Bank. If I take my mobile and look at the quotation, it will be 751 rupees 60 paise seller, 751 rupees 50 paise buyer. The difference between selling price and the buying price will be 5 paise, 10 paise, and that will remain only for a few seconds, and then the two will match and transactions will take place. This happens because speculation is allowed. Speculation creates a liquidity in the market. The stock market is speculative, but as an investor, you did not go for speculation. That is for traders. You don't speculate, you invest only. Third is stock market is for the rich. Another myth. What is the reality? You can buy the stock of Tata Steel, one of India's oldest companies, by paying 1,200 rupees. 1,200 rupees, even beggars have more than that now. Recently, I came across the story of a beggar in Cochin. When her bundle was opened, they got a few lakh rupees. You can start investing in mutual fund with as low as 500 rupees. You can buy the Nifty if you are not expert enough to buy a particular stock. You can buy a fraction of the Nifty. So it is not for the rich. It is for the Aam Aadmi also. Stock market is highly volatile, true. It is not a myth, it is a reality. But it need not be a concern of the investor, because this volatility will impact only traders. Right? Today the market is, as I speak to you, yesterday the market census was up 1,016 points. Today the market is down by how many points? As I speak to you, Nifty is down 20 points. Yesterday it was up by more than 290 points. But I am not bothered, because I am an investor, right? TCS is now 3,600 rupees. By the time the market closes today, it may be 3,570 rupees or 3,640 rupees. I don't care, because nothing happens to the company. This is all technical factors of demand, supply, things like that. And last point, this is very important. Many traders have lost money. Many people tell me that. Large number of investors will not lose money if you are a sensible investor. But large number of traders have lost money, true. Lakhs and lakhs of people have lost money because they become greedy. When you come to the market, you find the potential of the market to create wealth. You become greedy and you start speculating in the market, trading the market recklessly, unnecessarily, and lose money. The founder of Zerodha, India's largest stockbroking platform, they have an online trading platform, Zerodha. The founder of that, Zerodha, Nitin Kamath, said 90% of their traders lose money. He said, you don't trade like this and lose money. 90% minimum. But if you are an intelligent investor who invests in good quality stocks and shows patience to remain invested for at least 5 years, 99% you will make money. 99%. But if you are a trader, I will repeat this point, 90% chances are that you will lose money. So my request to you, I will not use the word advice because I am not wise enough to advise you, but my request to you from my experience in the market and also my experience in not only the theory but also the practice of the market all these decades, I can say with complete conviction that good investment can create phenomenal wealth, big amount of money. I've been working since 1978. I worked in college for 32 years, retired in 2010. After this 11 years, now the 12th year, I'm working in top management of Geojit. My job is essentially an academic job in nature. So 42 years working and earning money, but let me share a secret with you. Since you are all my fellow teachers, I'm sharing the secret with you. I made far more money from my investment than all the money that I earned by working for 42 years, several multiples of that. You can also do that if you are a systematic long-term investor in the market, because the next 10 years, by 2030, 8 years, India will be a 7 trillion economy. Now we are a close to 3 trillion economy. And we become a 7 trillion economy, and we were a $300 billion economy in 1991. Now we are 3 trillion, and finally we'll become 7 trillion, 10 trillion, no doubt about that. Indian companies will grow, huge profits. The total profit of India's companies, all the companies put together in 1991, the year we started reforms, the entire profit was 7,400 crores. 7,400 crores, I repeat, for the total profits made by all the companies in India put together in 1991. Now TCS makes more than 9,500 crores in 3 months. 3 months, more than 9,500 crores. Last Q2 results. HDFC Bank's results, profits are much more. Reliance profits are much more. TCS is a great clean company. That is why I took the example of TCS, because there are many people who do not like Ambani. Therefore, I deliberately avoided Reliance Industries, even though it is the most profitable company in India. Therefore, don't be a trader. Invest in the market. Invest in high quality stocks, high quality companies, globally competitive companies, which will be there 5 years from now, 10 years from now, 15 years from now. And when the companies grow, increase their profits, and they create wealth, you also participate in that wealth creation by becoming a passive investor. You are not an entrepreneur, right? I share this experience because it is very, very important. I told you I've been an academic all my life, 32 years in college teaching economics, and last 11 years, 12 years now, mainly doing an academic job, investment advisory in the corporate sector. So I'm not an entrepreneur. I've been an academic. But I did one business. And what was that? One business that I did was to identify good companies and invest in them. So in my portfolio, no, I have HDFC Bank, ICICI Bank, Axis Bank, Infosys, HCL Technology, Hindustan Unilever, Larsen and Toubro, like that. These are great companies. And when these companies grow and create wealth, an academic like me gain from that wealth creation because I am a shareholder. As simple as that. It's a simple commonsensical thing, but this simple common sense is not appreciated or understood by 99% of investors. 99% of educated people who invest. And that is why I am emphasizing this point with you. But let us very quickly go, because I told Gopika at the beginning that I will be speaking for about 45 minutes and then setting apart 15 minutes for Q&A session. For the next 5 minutes, I will quickly go through the next slides and then we will go to the Q&A session. Next slide, please. And then next, this is the tax structure. This is for you to understand. I am not explaining this. This is the new and the old tax structure that we have, the income slabs, etc. You might be knowing this, therefore I am not explaining. Let's go to the next slide, please. From the investment perspective, what is the implications of investment? When you get dividend from your investment till 2020, dividend was completely exempt. Now dividend is treated as part of your income and taxed in the same tax rate at which your tax slab is. For example, if you are in the 30% tax bracket, you have to pay 30% tax on that. If you are in the 10% tax bracket, you pay 10% tax on that. If you are not a taxpayer, then you don't have to pay. Suppose your only income is income from dividend, and that is 2 lakhs, you are not paying any tax on it. And long-term capital gains are the gains that you get by remaining invested it for 1 year and selling after 1 year. Long-term capital gains are exempt up to 1 lakh. Beyond 1 lakh, long-term capital gains are taxed only at 10%. Right? Now, if you have it is possible to smartly use this loophole, if I may use that expression. For example, I'll give you again my own example. In my family, I have my wife and 2 daughters. There are 4 accounts. I have my account, my wife's account, my 2 daughters' account, right? You can have multiples of that. My wife and I can have another account. My wife and I and my elder daughter can have one account. My wife and my younger daughter can have another account, but I am keeping 4 accounts. In these 4 accounts, you can take 1 lakh each long-term capital gain and pay 0 tax. Right? But then you have to smartly plan that when you are buying the stock, when you are selling the stock, reach a maximum of 1 lakh a year and then stop there. So 4 lakh of capital gains is possible if there is 4 lakh accounts, 4 accounts in one family. Theoretically as well as practically, this is possible. That's why I gave you my example. But if you have short-term capital gains, that is buying a stock and selling it before 1 year, then it's called short-term capital gains. And short-term capital gains are taxed at 15%. We'll go to the next one, please, very quickly. Dividend is next one. Equity fund also, the same logic is applicable. Dividends are taxed according to tax slab. Long-term capital gains are tax-free up to 1 lakh. Long-term capital gains beyond 1 lakh are taxed at 10%. Short-term capital gains are taxed at 15%. I'm skipping the other part, debt fund, that is not necessary for you. Next one, please. There's a big changes happening in the investment landscape in India since 1980s. In the 70s, 80s, 60s, 70s, and 50s, 60s, and 70s, Indian stock market was not performing well because the economy was not performing well. Growth rate was only less than 3.5%. Tax rates were very high. But in 80s, the economy started doing well. First dose of liberalization happened in 80s. Then in 1991, under the leadership of Narasimha Rao, one of the best prime ministers India had, Narasimha Rao introduced liberalization in India, and Indian economy started growing very fast after that, and tax rates were brought down, income tax rates, corporate tax rates, and companies' profits started growing very fast. But then when the corporate profits started increasing, I gave you this example. In 1991, the total profits of the corporate sector was 7,200, 7,400 crores. Last year, it was 5.4 lakh crores. This year, it will be more than 7 lakh crores. See the explosion that is happening. But then, unfortunately, in India, only a small minority, we have around 7 crore demat accounts in India. All that happened during the last 1 year, big explosive growth. But the real investors in India who gained from this investment were the foreign institutional investors. FIIs, foreign portfolio investors, sovereign wealth fund like Temasek or Abu Dhabi Investment Authority, or Stanford University or Cambridge University or California Pension Fund or Canadian Pension Fund. These companies, these foreign portfolio investors had invested in these great companies of India. And when these companies grew, they benefited. People in India did not, only a small section, only the people who invested through the mutual funds and a small minority of HNI, high net worth individuals, people who had an understanding of what the stock market is and how investment should be done. Only a small minority benefited. Vast majority did not benefit because they chose bank fixed deposits and gold, which did not perform anywhere near performance of the stock market. Therefore, it is very important that in the next several years, when India grows, when corporate profits increases, when India's corporate sector grows, you should also participate in that wealth creation, which this corporate growth can ensure. While continuing with your profession of teaching commerce and management in colleges, you can be a smart investor. And take it from me, you will learn a lot more about finance, a lot more about accounting. For example, Saurabh Mukherjee, I told Gopika about this, Gopika and Shalini, in the informal discussion that we had. Saurabh Mukherjee's coffee can investing will give you deep insights into accounting, which will enable you to teach accounting better in the classroom, and that is not taught now, because what you are teaching in the classroom is that the accounting standards which is available in the textbooks, right? There is forensic accounting now. So read Saurabh Mukherjee's Coffee Can Investing and learn the 10 principles of forensic accounting. Your knowledge will increase. You will understand what is happening, how to identify great companies and mediocre companies, how to identify companies with clean accounting, clean management. There are many in India, a few hundred companies. That will enable you to make the right kind of investment also, how to choose great companies. Next one, please. Mutual funds, I'm skipping this because we don't have time. You can read and understand. We'll skip this also. Again, I will skip. One more. SIPs, I believe you know, systematic investment. But I will take 30 seconds to explain this. This gives you again the power of compounding. No, previous one. Yes. No, after this. Go to the next one. Yes. So I given this. This is very simple. A and B. A started the SIP at 30 years. B started SIP at 35 years. Both of them invest up to 60 years of age. 60 years of age. Right? They are investing 5,000 rupees every month. What happens? A will be investing for 30 years. B will be investing for how many years? 25 years. A will be investing 18 lakhs. B will be investing 15 lakhs. And if we assume a return of 12%, A will be getting on retirement 1 crore 76 lakhs 49,568 rupees, whereas B will be getting only 94 lakh 88,175. The difference is more than 84 lakhs is the difference because of the 5-year gap, right? Only because of 5-year gap. So this is why the power of compounding is important. The earlier you start, the better. So I'm not saying that you should start at 30. Suppose many of you may be 40 now. No problem. Start at 40. Because starting at 40 is better than starting at 45. Starting at 45 is better than starting at 52. Right? So this is another example of power of compounding. You go to the next slide, please. This is the last one. The India growth story. It took 60 years for India to become a 1 trillion economy. That was in 2007. In 1991, we were at $300 million economy. 1/3 of a trillion when we started liberalization. We became a 2 trillion economy, doubling in 2015. Our Prime Minister's goal was to make India a 5 trillion economy by 2024. It is not going to happen because COVID has taken 2 years from us. Our GDP contracted by 7.3% in 2021. So, but of course, we will be reaching 5 trillion, no doubt about that. We'll have to extend it by a few years. We will be becoming a 5 trillion economy in 2027, and my rough estimates tell me that we will become a 7 trillion economy by 2030, barring unforeseen circumstances. So when we become a $7 trillion economy by 2027, we will become a $7 trillion market cap also. Our market capitalization also will be 7 trillion. Huge wealth creation will happen. The prices of many stocks will increase. Double, triple, quadruple, increase 5-fold, 10-fold. But in between, there will be big volatility. There will be big crashes in the market. You will come across news. Because the media is specializing in scandalization. I remember in November 2016, the scrolling news in one Malayalam channel was Ohari Vibani Tagarna Adinu. Tagarna Adinu Chalinium Karan Yaduru Shilian. I called some of my friends there and told them, what are you doing? In the next 2 days, the decline was more than compensated, right? But they kept quiet at that point of time. So you will come across stories, you will come across news of big volatility, market crashes this year. The coming year, 2022, there will be big crashes because there can be big declines in the market. Nobody can predict this. It is impossible to time the market. But then market correction is good because if you are a systematic investor, investing systematically, well, a market correction will give you the opportunity to buy a stock at a lower price, right? So when the Indian economy becomes a 7 trillion economy by 2030, when the market cap increases to 7 trillion by 2030, when the corporate profits of India's companies will rise to around 20 lakh crores by 2030, my estimates. From 5 lakh crores last year, 5.4, will be 20 lakh crores. By 2030, you can also participate in wealth creation even while continuing teaching accounting and management in Sankara College, Kalady. So please do that. So we have another 5 minutes. I have exceeded the time limit by a few minutes. So we have next few minutes before I wind up this session. If you have some questions, I'll be glad to answer the questions. So please take over.
And
you can straight away. Yes, Shalini, go ahead.
And that was a very well informative session. So faculties and participants, if you have any doubts, you can clear it now.
Good morning, sir. Myself, Dr. Raina and Isaac, a faculty of commerce. I was very much impressed and very much inspired by your session, sir. Actually, the first step to enter into the stock market trading, I think I got that initial. Sir, can you hear me?
I can hear you. There's some disturbance in the background, but I can hear you. I can
Okay,
hear you.
sir.
Go ahead.
Sir, as someone who want to invest in stock markets initially, whether the small caps or the medium caps or the large caps, which one would you prefer?
Okay. Okay. Thank you for that question. In a bull market, small caps, what we call the broader market, the small and mid caps outperform the large caps in a bull market. If the market goes up by 15%, the small caps will go up by more than 20%. But if you have a bear market and the market is coming down, the safety is in large caps because the small caps decline by let's say 20%, the large caps will decline only by 5 or 6%, right? So ideally, you should have a diversified portfolio consisting of large caps, mid caps, and small caps. An easy solution to this problem is you invest in a Flexi Cap portfolio. In a Flexi Cap mutual fund portfolio, there are many large number of good Flexi Cap mutual funds. Kotak Flexi Cap Fund, Motilal Oswal Flexi Cap Fund, like that. There, your money will be invested in large caps, mid caps, as well as small caps. So when the large caps are overvalued, they move money into small caps. If small caps are overvalued, they move money into large caps. So that takes care of the risk there.
Thank you, sir. Is it like a balanced fund?
A balanced fund is a fund that allocates a part of the money in equity and the rest of the money in bonds. Right? It is a balanced fund now called a hybrid fund. Let us say 60% will be in equity and 40% will be in bonds. In Flexi Cap Fund, or let us say in a multi-cap fund, 33% will be in large caps, 33% in mid caps, 33% in small caps. In a Flexi Cap Fund, the fund manager has the flexibility to allocate. He can have 50% in large caps, 30% in mid caps, 20% in small caps, or 60% in small caps and the rest in mid and small caps. The fund manager has the flexibility, and the fund manager will take a call on this based on the valuations of large caps, mid caps, and stocks and the small caps at a particular point of time.
Okay, thank you, sir.
Good morning, sir.
Good morning.
I am Jay Krishnan.
Ajay Krishnan.
I am Jay Krishnan, sir. Sir, so it is very nice. Very happy to see you again, sir, and have an up-to-date investable informations right from the mouth of the market source. Thank you so much, sir. One thing, sir, so many IPOs are coming. So how do you view these IPOs in the light of Paytm issue?
Right, very good question, Jay Krishnan. I can't see you. Is this my old student, Jay Krishnan? I can't see you here.
Same. Yeah, sir. Jay Krishnan, sir.
Okay.
Yeah, yes, sir.
I should have known from your voice. But are you in Sree Sankara College now?
No, sir. I am in NSS College.
Okay.
College,
you just participated.
Sir, sorry to interrupt. Vijayakumar sir, this event is not only for the faculty members of Sree Sankara College.
Okay, right. Good. I thought this is mainly for the faculty of Sree Sankara.
Participants from national and international.
Now I understand.
Thank you, sir.
Right. So that's why I use that Kalady example quite often. Okay, anyway, glad to hear your voice, Jay Krishnan. Your question is very valid now. One has to be very careful about the new IPOs. IPOs, particularly of this new age digital companies like Nykaa, Paytm, and companies like that. These are highly priced, and there is a fad in the market, right? And some of the stocks like Nykaa, for instance, Nykaa is quoting at 1000 PE, 1200 PE. Youngsters are buying as if there is no tomorrow. I am very concerned about that. This will not last. There will be a crash. And in Paytm also, even marquee investors like Canadian Pension Fund, And BlackRock investors, BlackRock investment, they had invested 7,100 crores. Actually, I am writing an article about that. Smart investors are not very smart. And they have actually lost more than 20% in Paytm, right? Because the share was highly overpriced, highly priced. Now, the point is there is no last word on the pricing of these stocks, because you take Swiggy, for example. The most respected valuation guru, one of the most respected, is Ashud Damodaran, Professor Ashud Damodaran of Stanford University. He says Swiggy is sometime back, I don't know what he says now. According to him, Swiggy is worth only 40 rupees. But Jeffries, according to Jeffries, Swiggy is worth 150 rupees. Right? We don't know, because we don't have any traditional parameters like earnings per share, PE ratio, price to book, etc. Because many of these companies are yet to make profit, right? But then, if these companies succeed, like Amazon or Google or Facebook has succeeded, then even 150 will be a low price, right? But if they fail, you stand a possibility of losing money. So it is highly risky. That's the point. And we don't have valuation parameters. I hope my point is satisfactory to Jay Kishan.
Okay, sir. Clear, sir. Thank you. Thank you so much, sir.
Okay, nice to meet. I can see your photograph now. Nice to meet you. Bye.
Okay, sir. Okay, sir.
Next question.
So may I ask you one doubt?
Oh, please.
So when we look into the financial performance scores like Petrosky and Fibonacci scores, the financial performance of the companies may be less. But when we look into the stock prices, sometimes it may be high. Why that stock prices are not truly representative of the financial performance of the company?
And this the explanation that I gave to Jay Kishan partly answers your question. The share price depends on large number of factors. In the long run, fundamentals are relevant. Share prices, there's a saying attributed to uh, what is his name? Intelligent investor Graham. What? Not remembering names properly. There, Benjamin Graham. Benjamin Graham. If you have not read Benjamin Graham's book Intelligent Investor, please read that. That is regarded as the Bible of stock market investing. And Benjamin Graham was the guru of Warren Buffett, and Warren Buffett regards him as the greatest stock market guru of all time, right? Person who taught market investment correctly. Now, in the long run, Benjamin Graham famously said that in the short run, the market is a weighing machine. It's a voting machine, and in the long run, it is a weighing machine. What it means is, in the short run, there are large number of factors, technical factors. So you are the Fibonacci number and the technical factors, the technical patterns, the head and shoulder pattern, the candlestick pattern about the technical movements which the technical analysts talk about, that have short-term relevance. For example, yesterday, the BSE Sensex shot up by 1,016 points. A large part of that sharp rally was because of the short covering. Because on Monday, the market went down because of this scare created by the Micron variant of the COVID variant, the new COVID variant.
Omicron.
What is the Omicron? Yeah, Omicron. This Omicron variant of coronavirus created a lot of scare, and people were really concerned whether again we will go into a lockdown impacting economic activity. So there was a big crash in the market, and when there was a big correction in the market, large number of bears go short, expecting the market to go down again. But what happened was just the reverse. The price went up, and that creates short covering. People who went short in the market, who shorted the market, selling shares without owning that is short selling. They were forced to cover, and that short covering led to sharp increase in the price of many stocks. So in the short run, all these technical factors become relevant. But in the long run, technical factors are not relevant. These are the fundamentals: earnings per share, price to book, market cap to GDP. These are the important fundamental factors. An investor need not look into the technicals. An investor should look only at the fundamentals of the stock. Any other question?
Any questions from the participant side?
If you don't have any questions, Gopika, we'll conclude.
Yeah. Shalini, please unmute yourself.
So how many participants from other colleges, like Jay Krishnan, for instance? How many from other colleges? Total, how many participants?
Apart from the 11 participants from our college, the other 44 are from other colleges.
So you had 55 in all total?
Yes, sir. Yeah.
Very good.
I hope all your doubts are cleared. Thank you, sir, for such a wonderful session. So the stock market always have its charm and also a very crucial investment decision. But still, the investors are averse to invest in stock market, but due to the high risk element. The in-depth explanation given by Dr. V K Vijayakumar sir gives us a confidence to enter into the stock market. So once again, I use this opportunity to convey our sincere gratitude to Dr. Vijayakumar sir for joining us and sharing a wonderful session regarding wealth creation, and also thanking all the faculties who have joined here for the session. Thank you, sir, and thank you all. Also, so we can wind up the session. The next session will be at 2 p.m. and please do reassemble at the time. And also a link is provided in the Teams chat box for marking the attendance. A Google form is provided there. Please do that also.
Thank you.
Thank you.
Thank you so much, sir, once again.
Thank you, sir.
So let's wind up this session. Thank you all.